Hello and welcome. Today, we are going to unpack one of the most powerful financial concepts on the entire planet. Seriously, it's a force that can turn tiny, consistent savings into absolutely life-changing wealth. But it requires one crucial ingredient, one that, once it's gone, you can never get back. So to get started, let's frame this as a kind of financial race. A puzzle, really, where the winner isn't who you'd expect at all. And here's the central question, the one that sits at the heart of everything we're talking about today. How is it even possible for someone who invests way less money to end up with a bigger fortune than someone who invests way, way more? I mean, it sounds completely backward, right? It feels like it breaks the fundamental laws of math. But as you're about to see, it's very, very real. The answer lies in a force so powerful that Albert Einstein himself supposedly called it the eighth wonder of the world. And that force is compound interest. This concept is so fundamental, it's one of the cornerstones of building wealth. So welcome to everything you need to know about finance. Now, just a quick note, this is a deep dive for informational purposes. It's not financial advice. If you find this kind of content interesting, please take just a second to like and subscribe. It honestly helps us out a ton. Okay, let's get into this. Okay, so take a look at this. Here are our two investors. The early bird on the left ends up with over $2.1 million. The late investor on the right, just under $2 million. Now here's the mind-blowing part. The early bird, the one who won, only invested for 10 years. The late investor saved consistently for 30 years. So how on earth does someone who invested for a third of the time end up richer? To solve this mystery, we really have to dig in and understand the engine that was powering the early bird's success. It's a concept that sounds simple, but once you get it, it changes everything. So let's break down what compound interest actually is. At its core, compound interest is just this. It's the interest you earn on your original money and on the interest you've already earned. The best way to think about it is like a snowball. You start with a small ball of snow at the very top of a hill. As it rolls, it picks up more snow. But the bigger it gets, the more snow it picks up with every single turn. Your money works exactly the same way. It grows, and then that growth starts to grow, creating this incredible, unstoppable momentum. And this is really the key difference between compound interest and, simple interest. With simple interest, you only ever earn money on your initial investment. That's it. It's linear growth, a straight, predictable line. But with compound interest, your earnings get thrown back into the pot and they start making money too. That creates exponential growth. It's not a line, it's a curve that gets steeper and steeper and steeper over time. Let's make it super simple. Say you invest $100 at 5% interest. After year one, great, you have $105. But in year two, you earn 5% on the entire $105, not just the original $100. So now you have $110.25. And that little extra 25 cents, that's where the magic is. That is your interest earning its own interest. It seems tiny, but that is the seed that grows into a giant tree. So, okay, now we know what it is. But the real secret, the part that truly matters, is in how it works. And there are two key ingredients, but believe me, one is way more powerful than the other. And here it is. The single most important factor in compound interest is time. It's not about how much money you can invest. It's about how much time you give that money to grow. Every single year adds another layer to that snowball, making it bigger and letting it roll faster. This is why the first few years of investing are the most powerful, because they have the longest runway for growth. And hey, you want a cool way to actually feel this power for yourself? There's this fantastic little mental math trick called the Rule of 72. It's a super simple way to estimate how quickly your money can multiply without having to pull out a crazy spreadsheet. Seriously, this is how easy it is. You just take the number 72 and you divide it by whatever interest rate you expect to earn. So let's say you're hoping for a 9% return. You just do 72 divided by 9 and you get 8. And that's it. That means your money will roughly double every 8 years. Simple, right? But think about what that means. An investment made when you're 25 could double 4, maybe 5 times by retirement. But an investment made at 45, it might only double twice. That difference is absolutely massive. Okay, now that we understand the mechanics of compounding, and especially the critical role of time, let's circle all the way back to our original puzzle. Let's solve the mystery of the early bird and the late investor. This table just lays it all out there. Look at this. The early bird invests $120,000 over just 10 years and then stops cold.
The late investor puts in $360,000. That's 3 times more money over 30 years. And yet, the early bird ends up with more. Why? Because their money had an extra decade to just sit there and work. But the real hero of this story is the consistent investor. By starting early and just never stopping, their $480,000 contribution explodes into almost $7 million. That is the power of time and consistency working together.
So let's just nail this down. Why did the early bird win? Because their investment had a 40-year runway to grow, even though they only added to it for 10 of those years. The late investor's money only had a 30-year runway. That first decade is where all the magic happens. It builds the foundation for all the future growth. The money you invest in your earliest years works the hardest for the longest amount of time, period.
Look, this isn't just a fun math problem. This has a really profound implication for how every single one of us should be thinking about building wealth. It completely reframes what our most important resource really is.
And that brings us to maybe the single most important takeaway from all of this. Your most valuable financial asset, it isn't your income. It isn't how much money you have in the bank. It's how much time you have. If you're young, you are rich in the one thing that matters most for long-term growth. Every day you wait to start is a day of compounding that you can never, ever get back. And that should feel incredibly empowering because it means you can start building real wealth right now, no matter how small you start.
It's really no surprise that this idea is so famous. This quote, which is often attributed to Einstein, just perfectly captures the two sides of this powerful coin. If you understand compound interest, you can harness it, you can earn it, and you can build a future with it. But if you don't, you often end up on the other side of that equation, paying it on things like credit card debt, where that exact same force is working against you.
So we'll end with this question for you. The clock is always ticking. That snowball is sitting at the top of the hill, just waiting. The earlier you give it a little push, the bigger and more powerful it's going to be when it reaches the bottom. The math is clear, the power is undeniable. The only variable left is you. Thanks for joining us.